Introduction: the hidden power of your credit score. Your credit score, it's just a three-digit number, right? Yet this small number holds the power to shape one of the most important financial decisions you'll ever make: buying a home. Whether you're a first-time home buyer or looking to refinance, your credit score can determine how much home you can afford, how much interest you'll pay over the life of your loan, and whether lenders will even approve you. A higher credit score can mean the difference between securing a loan with a low interest rate and paying tens of thousands more in extra interest over time. On the other hand, a low credit score might mean you get stuck with a higher rate, or worse, denied for a mortgage altogether. So today we're breaking it all down. We'll discuss how lenders evaluate your credit score, how different score ranges affect mortgage rates, and what steps you can take to improve your score before applying for a home loan. By the end of this video, you'll have a clear roadmap to getting the best mortgage rate possible, saving you money and helping you achieve home ownership on the best possible terms. Let's dive in. What is a credit score and why does it matter? Before we explore its impact on your mortgage rate, let's first understand what a credit score is and why it plays such a crucial role in home financing. Your credit score is a numerical representation of your creditworthiness, essentially how reliable you are when it comes to borrowing and repaying money. It's calculated based on your credit history and is typically measured on a scale of 300 to 850. The higher your score, the less risky you appear to lenders. The most commonly used credit scoring model is FICO, which is used by the vast majority of mortgage lenders. The score is determined by several key factors. Payment history, 35%. Do you pay your bills on time? Late or missed payments can significantly lower your score. Credit utilization, 30%. How much of your available credit are you using? High balances relative to your credit limit can hurt your score. Length of credit history, %. How long have you had credit? A longer history generally leads to a higher score. Credit mix. Do you have a mix of credit types, like credit cards, auto loans, and student loans? A good mix can boost your score. New credit inquiries, 10%. Have you recently applied for new credit? Too many inquiries in a short period can lower your score. Lenders use this score to determine whether they will lend to you, how much they're willing to lend, and what interest. Mortgage lenders use risk-based pricing, which means that borrowers with higher credit scores get better interest rates because they pose less risk. Here's a general breakdown of how credit scores affect mortgage rates. Excellent, 760, 850. You'll qualify for the lowest interest rates available, which means lower monthly payments and huge savings over time. Very good, 700 to 759. You'll still get great rates, though they may be slightly higher than those in the top tier. Good, 666, 699. You'll likely qualify for a mortgage, but your interest rates will be noticeably higher. Fair, 620.59. You're still eligible for certain loan programs, but interest rates will be high, and you may need to put down a larger deposit. Poor. Below 6, many conventional lenders will deny your application, but some government-backed loans like FHA might still be available, though at higher costs. For example, let's say you're taking out a $300,000 mortgage for 30 years. If you have a 760 plus credit score, your interest rate could be 6 cent, resulting in a monthly payment of about $1,798. But if your score is 620, your rate could be 8%, pushing your payment up to $2,201. Over 30 years, that's an additional $144,000 in interest, just because of a lower credit score. That's why even a small credit score increase can lead to huge savings over time. Government versus conventional loans. How credit score plays a role. Your credit score affects not just your interest rate, but also the type of loan you qualify for. Here's how. Conventional loans. These typically require a minimum credit score of 620. The higher your score, the better your rate and terms. FHA loans, designed for borrowers with lower credit, These allow scores as low as 500 with a 10% down payment or 580 with a 3.5% down payment. However, FHA loans come with mandatory mortgage insurance, which adds to your monthly costs. VA loans, available to eligible veterans and active military members, these loans don't require a minimum credit score, but most lenders prefer at least 620. USDA loans, designed for rural home buyers, these loans typically require a 640 plus credit score for the best rates. If you have a low credit score, you may still qualify for a mortgage, but it could come with higher interest rates, more upfront costs, and additional fees. How to improve your credit score before applying for a mortgage. If your credit score isn't where you'd like it to be, don't worry, there are steps you can take to improve it before applying for a mortgage. Even small changes can make a big difference in the interest rate you qualify for. Here's how to boost your score. 1. Pay your bills on time. Since payment history makes up 35% of your credit score, missing even a single payment can drop your score significantly. Set up automatic payments or reminders to ensure you never miss a due date. 2. Lower your credit utilization. Try to keep your credit card balances below 30% of your credit limit. For example, if your credit limit is $10,000, try to keep your balance under $3,000. The lower your utilization, the better for your score. 3. Don't close old accounts. The length of your credit history matters, so even if you're not using an old credit card, keeping it open can help maintain a strong credit profile. 4. Avoid applying for new credit before buying a home. Each new credit application results in a hard inquiry, which can temporarily lower your score. Try to hold off on new credit cards, car loans, or other financing while preparing for a mortgage. 5. Check your credit report for errors. Mistakes happen, and errors on your credit report could be dragging your score down. You can request a free credit report from the major credit bureaus, Equifax, Experian, and TransUnion, and dispute any inaccuracies. 6. Reduce debt. Paying down existing debt not only boosts your credit score, but also improves your debt-to-income ratio, which lenders use to evaluate your mortgage eligibility. Even a small increase in your credit score can save you thousands over the life of your mortgage. If you can boost your score by 20 to 50 points, you may qualify for a significantly lower interest rate. Conclusion: a higher credit score means big savings. Your credit score is more than just a number. It's a key factor in determining how much home you can afford and how much you'll pay in interest over the life of your mortgage. A higher credit score can mean lower monthly payments, less money spent on interest, and better loan options. If you're planning to buy a home, start working on your credit now. Even small improvements can lead to big financial savings in the long run. For example, if you increase your score from 650 to 720, you might secure a mortgage with a significantly lower interest rate, saving you tens of thousands of dollars over 30 years. That's money that could go toward home improvements, investments, or your savings instead of interest payments. So, whether you're just starting your home ownership journey or looking to refinance, your credit score is one of the most powerful tools at your disposal. The better your score, the more options and savings you'll have. Now, I want to hear from you. Have you ever taken steps to improve your credit score? What challenges have you faced? Drop a comment below and let's talk about it. And if you found this video helpful, hit that like button, share it with a friend, and subscribe to Journey Realty Group for more expert home buying tips. Thanks for watching, and I'll see you in the next video.